Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Thursday, May 8th, 2025. Today's episode begins with our headline, Tariff Deal Sparks Rally, Stocks, Dollar, Bitcoin Up, Gold Slips. The amount of uncertainty in markets surrounding the tariffs and the tariff deals, if deals would ever be made, has been making a lot of markets pretty skittish, and today was the first sort of olive branch that has been put out there, and so now we can sort of assume that more deals will happen. Not all markets are convinced, though. I see more complacency than anything, but it can explain market action today. Next headline, we had Jobless Claims Dip after multi-year high. What I'm referring to is from the Fred, the continued claims. This is released every Thursday. I noted last Thursday, and I've been talking about all this week about this coming out. This is seasonally adjusted, by the way. If you look at the seasonally unadjusted seen here, we are not seeing new highs, but we did see new highs in January, where we typically see the peak. Overall, this chart simply shows the very clear higher high, higher lows going on year over year. And back to the seasonally adjusted version of it, we ticked down a bit, but not a lot. Moving forward, I think this is a huge thing to keep a very close eye on, especially regarding the fact that there's lots of companies out there that are concerned that business might not be so hot moving into the future, and this can cause layoffs. This can cause the initial jobless claims to start spiking and the continued claims to also rise. My crystal ball was suspecting this going to the upside actually for this report, and it didn't. I know, Drakmar. I don't get every call right. Right now, I think this is the most important thing to really keep an eye on moving forward. Moving on to the community topics. What moves, if any, did you make today? Robschild did nothing. I just sat on my hands. Comment below what you are doing. Don't be afraid to share your thoughts. Coming up, as always, continuous tariff updates. And looking forward into next week, we have a CPI PPI report for, I believe it's the month of April. As always, thank you for watching, subscribing, commenting, and supporting. The subscription button's right over here. Just put your mouse on it and you click right there. And this is how you can support the channel. Info is in the description below. I've received a lot of support. Thank you very much. Before we move on to the charts, no changes in the daily reminders or macro views. Click the link, Daily Reminders, in the description to read my website explaining these very important things. And no major changes to the crystal ball ratings nor the Robschild portfolio, although Brazil is starting to go up a bit, so let's just alter it to 12%. We will talk about Brazil today. I mentioned it literally yesterday as a great setup, and long story short, it went up. Moving on to the charts, starting with the S&P 500, the SPX. We went up by 0.6% today. During the day, it seems like there were just as many bulls as there were bears, opening and closing exactly at the same spot. Some people have been noting a potential inverse head and shoulders developing where I have this yellow line written. And funny enough, with this kind of pattern, it actually will start looking more bearish if we just continue to go up through here, because it can take the power of this head and shoulders away if we just sort of float up through it and kind of negate this neckline here. But if we do get a movement lower and then back to the neckline, this is what some people are sort of seeing as potentially playing out. Then that can be a pretty big move in the S&P 500. We will probably, it looks just from eyeballing it, looks like we'll probably get back up to this trend line around, what is this going to be, 6,300? I don't have a lot of faith in this, but it's the patterns potentially developing here. Supporting the bullish move, the advanced decline line moved higher today, signifying this is a broad-based rally. We also had the VIX, the pricing of options contracts, which signifies the fear gauge of the market. It did drop to a new closing low that we haven't seen since Liberation Day, but we're not back down there yet. More notable than that, the VIX Futures term structure is like flat here, which suggests that volatility is high right now. I mean, look at this curve here. December is way below basically the next entire 6 months. So while before it looked like the market was saying, yeah, the market's on fire right now and things will be better in the future, this is now looking like the market's going to be on fire for quite a while here. This is sort of what the VIX is saying, or, not on fire, but, the expectations of another potential crash are high. Institutions that are selling these contracts don't mess around. They're not going to give a discount to these contracts unless, the green light is really fully on, and it's not. That's very clear in the VIX Futures. As I mentioned in the title, the dollar got a bid today. Many people weren't expecting to really get above 100, and we broke through higher than 100. We are not scared of the dollar as much as we were before, based obviously mostly probably on this tariff news. I've been hearing a lot of voices very bearish on the dollar, and I can't figure out why. I don't see any solid enough reasoning for the dollar to just keep collapsing. In fact, with Treasury rates being so high, to me it's the most attractive fiat currency that exists in the world right now. And I'll add to that, I will not be surprised at all to see the dollar continuing to rip higher from here, breaking everyone's expectations. But, that's just me and my crystal ball. Also, I mentioned in the headline, Bitcoin went up by 6%, and so I guess we can call this risk on. My understanding is that the thought process behind Mr. Market today is that business isn't going to be as bad as we thought because we are actually going to make some tariff deals, and so Mr. Market's allowed to put his the pedal to the metal, as they say. And with less uncertainty, it allows gold to continue to cool off here a little bit, down 1.7% for the day. TLT, my favorite place to be, while being in a correlated state with the S&P 500. We went into an uncorrelated state recently, and we are very clearly still in an uncorrelated state. When stocks go up, TLT goes down. This is, okay, I don't need to be so safe. So we're going back into stocks, at least, for the day. Just to once again emphasize my daily reminders, I want to bring up the 30-year Treasury bond yield, 4.84% right now. This is very oddly high, which is why TLT is my favorite place to be. Whether you measure it based on PE ratios of stocks, or if you think about the fact that demographics are still aging, or you consider that all of the other world currencies that are not the global reserve currency have much lower guaranteed yields, it screams undervaluation to me and opportunity, which is why I keep saying when we get back down to this fight zone here, this previous gap fill, which it looks like we're headed there, that's when I will be backing up the truck, as they say. Before I talk about crude oil itself, typically yields follow crude oil. We collapsed. We're down here, around 60 barrels $60 a barrel of oil, a price not seen for many, many years at this point. 2021 is the last time that we saw this low of a price in crude oil, and yet treasury yields are so high. But, my portfolio speaks for itself. I wouldn't have over 50% of my portfolio in long duration treasuries if I didn't think it was a heck of an opportunity. But I digress. We're looking at crude oil today because we went up by 2.83%. I don't know where we're going from here. A lot of chartists are looking at, I think I heard the number 53.15 is kind of the expectation of the first major expected support level. I also want to point out that the MOVE index, I've been talking about it clearly going lower and lower, and it's still going lower and lower. I'm sort of seeing in my crystal ball getting down to that gap fill in TLT as being like perhaps the lowest TLT will be for many years, actually. Next, I want to bring up small caps. This is IWM, an ETF of the Russell 2000. While the S&P 500 looks like, we have this inverse head and shoulders and we might be getting a little more bullish. It's a little hazy in that respect. This chart is very bearish looking. It's telling quite a different story with very, very clear continuing lower lows and lower highs. And for there to be any chance at all for stocks to really continue a bull run to the upside, I really want to see this previous high taken out around 209 for me to believe that this lower high and lower low situation is actually over with. Next, I wanted to bring up July's Fed Fund Futures. Just wanted to note that the chance of no cut is rising. Yesterday's probability 33%, today's 39.4%. The Fed Funds Futures is kind of suggesting that we'll see more resilience in the U.S. economy for a longer period of time, at least from yesterday until today. Again, this is one news drop, but it was a big one. Yeah, it's the first tariff deal. I mean, it's a historic moment, really. You had the beginning of the tariffs, then the pause, and then the first deal. This is like step 3. So it's not really unexpected for the chance of no cut to be rising slightly here. Mr. Market, according to CNN Business, the Fear and Greed Index of CNN is comfy back in greed, the greed zone, we'll call it, while I'm still shaking in my boots a little bit, especially with the VIX curve still inverted here. It's just sort of like Mr. Market's car started smoking, so he pulled over and he stopped. That was Liberation Day. Now he's getting back in his car and all the lights are flashing and saying there's all these problems, and he's just hitting the gas and he's like, no more fear here, while the VIX light is still blinking at him. No, hey, your car's not okay. Next, I wanted to bring up copper. Because remember, Dr. Copper has a PhD in economics. This is like a reading as to what's going to be happening globally, with the economic activity. If globally things are heating up, everything's going great, copper can get a bid, it can go up. If things are looking shaky or like the world, global economy is about to fall apart, copper will tank. And what did copper do? Nothing. Just staying flat here. I think he's being a little sensible, to be honest, more than any of the other markets going completely flat for today. Next, I want to bring up EWZ. I talked about this fund exactly yesterday and talking about how it could be the buying time of a lifetime based on some trend lines that I found. Not just because this entire country of stocks found in this ETF, this is like the S&P 500 of Brazil. They're not just because they're paying out close to a 10% dividend, which is like insanely high for an entire index of a country, in dollars, by the way, with PE ratios that are just insanely too small. While at the same time the S&P 500 is just so enormously overpriced, it just seems like such an obvious reversion to happen. And then you have this epic trend line going all the way back to 2008 showing this wedge, and then we sort of have this other wedge going here. If you can follow what I'm doing here, this wedge starts at the top of December of 2023. We're hitting it 1, 2, 3, 4. It's a very obvious trend line, 5, 6, never being able to break above it, and then finally broke above it and we retested it, and that same level happens to be the low of 2024, a major pivot point in markets. This is a major sideways trend line. Both lines lining up perfectly, exactly in the right spot at the right time. This was the buying opportunity, and then it soared 4% today. I said yesterday specifically, if I wasn't already levered to the teeth with BRZU, a leveraged fund of Brazil, I would be buying it hand over fist. And yeah, it went up. It feels good to be right sometimes. And by this action of today, I mean, granted, we didn't close over this wick here, but which is what we want to see for even more obvious signs that this is going to continue higher. But this is extremely bullish looking to me, just however you want to see it. I fully expect Brazilian stocks to continue much higher from here. But Robschild, I thought you were so bearish on the economy. Oh, look at my portfolio, guys. I'm practically something like at least 40%. Yeah, I'm about 40% in stocks still. Benjamin Graham says never be less than 25% stocks, because you don't, with every tool in the world, you can't completely reliably detect when the tide is coming in or out. And while I still believe very strongly a major recession or depression is coming, I can't tell you if that's starting this week, this month, next month, or if we have to wait another year, actually, at this point. All I can do is buy things that seem ridiculously cheap and sit on them until they become a little bit more reasonably valued, and that's the way I play this game. That's the Robschild way. Benjamin Graham would be proud, or at least I'd like to think that he would be. Anyway, moving on, junk bond credit spreads. I just want to mention not continuing to tighten here. Not continuing to tighten today. Sorry, this is always one day. I always think this is the day of. It updates the day before. So to see what it's doing on a day-to-day basis, it's better to look at HYG divided by SHI. So we tightened like a tiny, tiny bit more today, but we're obviously not getting back down to, a lower low, I guess we can call it. We are still have a larger pattern of higher highs and higher lows in credit spreads. And so again, for me to be very confident that the market is done with its downside, we're heading up higher, I want to see the small caps break that level. I want to see the VIX go down. I want to see credit spreads get back down to 3.42 on the junk bond credit spreads or lower. Then I might be convinced that the S&P 500 and stocks can continue higher, and I'll benefit from that probably with the stocks that I have. I'll be looking for more exit points with those while trying to maintain at least a 25% allocation to stocks. I still have my strong doubts about everything continuing to just march on higher here, but I guess we'll see. One piece I'll add right here too is that So this is the first tariff deal that was made. There's not going to be another first tariff deal. So now that we have one tariff deal, that news is priced in, that we will have potential more deals coming, especially low-hanging fruit type deals. Some of the harder, longer deals might take a bit more work, like China. So my point is that I don't think the next deal that we hear about is going to be as bullish as what we saw today. Last thing I want to bring up today is a little bit of an interesting divergence of the 5-year break-even inflation rate and the 10-year, only because the 5-year ticked up today, obviously believing, yeah, the economy is going to be good, so inflation can go up here. This is like, when we're in this range, it's like a sigh of relief that we're not going to see further and further disinflation, which is where this market had been going. The 5-year inflation, break-even inflation rate, it was headed, it was lower highs, lower lows, just going down and down. And so going up here is more of a sigh of relief than anything. But then you take a look at the 10-year break-even inflation rate, and on the same day, we actually ticked down here. So again, like I said yesterday in my reaction to the FOMC meeting, the 10-year break-even inflation rate is one of the biggest things that the Fed uses to gauge whether they should cut or not. And if the 10-year break-even inflation rate is like in control, then the Fed's not going to do anything. If this drops below 2%, you better believe the Fed is going to cut aggressively. Just to show how right I am, do you remember that first cut of 50 basis points that everyone was saying, oh, he's doing that just to make, the previous president look good going into the elections? No. Let's stop worrying about politics. Look at where the 10-year break-even inflation rate was on September 10th. 2. Okay? This dropped precipitously from July to August. We hit, in August we went up, and then we dropped. We dropped down to 2, the target of the Fed. And at the same time, the yield curve was still essentially inverted here, suggesting the Fed was still strangling the economy with its hands around its neck, while the 10-year break-even inflation rate was dropping like a stone and hit 2. And then since then, we bounced back up higher, and then, yeah. So if this continues, like I'm saying, if this drops like really hard, that's when we will most definitely see aggressive cutting. Equally, if this starts spiking to the upside, they will start talking about hiking rates again. Just like we saw in February of 2022 when they started the hiking cycle. Once this started shooting up to almost 3%, the 10-year break-even inflation rate, that's when they said, uh-oh, we better start raising rates aggressively. That's when it happened. This is huge. This is no big deal. This is not no big deal. This controls the Federal Reserve's decisions maybe more than anything, actually. Especially considering how many times in recent FOMC meetings Powell has said directly, very stately and strongly, we can't have a good economy if we don't have expectations of inflation being under control. We need price stability in order for the economy to be healthy and working well. That's like, that to me is the deepest thought that he has from all of these FOMC meetings. And 10-year break-even inflation rate. I can't stress how important it is to be looking at this. I guarantee you Powell looks at this exact chart every single day. But I don't know. I mean, what do I know? I'm just a guy with a crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.